Hi there, and welcome to the Rede Liquidity Index key findings for the first half of 2022, looking at LP sentiment and expectations for private equity fundraising over the next 12 months. I'm Gabrielle Joseph, Head of Due Diligence and Client Development at Reed Partners. The Rli Score for the first half of 2022 is 55, indicating that on average, institutional investors intend to slightly increase deployment to private equity funds over the coming 12 months. We asked our panel of institutional limited partners whether they plan to increase, maintain, or decrease the pace of their investment programs over the coming 12 months. You can see that the majority of LPs plan to hold their investment programs steady, but a record 17% now expect to reduce their commitments to new funds in coming months. We've been gathering RLI data since early 2017, and you can see that this is the sharpest ever drop we've seen, even outstripping the fall we saw during the early stages of the coronavirus pandemic. That fall was exceptionally short-lived, with LP sentiment showing a major bounce back throughout 2021. But this confidence may turn out to have been misplaced. The geopolitical tensions, public markets volatility, and macroeconomic challenges we've experienced during the first half of this year seem to be really starting to bite, and LPs are now expecting a much lower pace of growth in their commitments to private equity funds over the next year. In particular, investors are telling us that they will have much less capital available to commit to managers where they don't already have a relationship. With a squeeze on the capital available for fund investments overall, LPs are prioritizing re-ups. You can see here the very sharp fall in LP expectations for new money commitments. That's going to create real issues for fundraising momentum as a whole, but particularly for GPs who are looking to scale up their fund sizes. It's going to be even tougher for first-time funds who, by very definition, need to raise substantially all of their fund as new money. Emerging managers will need to brace for longer, tougher fundraisers and would do well to seek out anchor-type investor relationships who can back these managers on a deal-by-deal basis in advance of a first or final close. The fall in the headline RLI is to a large part driven by LP's extremely bearish outlook on distributions. When investors receive a steady flow of exit proceeds back from their managers, it bolsters the capital that they have available for re-ups and new commitments, and that's independent of the capital they receive top-down from their asset allocations or their client relationships. We've seen some record exit activity since late 2020, with a succession of eye-catching home runs and a benign IPO market. But the latest data that's coming in for Q1 2022 shows a real slowdown in M&A activity across the board and a major drop in IPO proceeds. Added to that, the conflict in Ukraine and its knock-on effects on energy and raw material prices, supply chain disruption, and consumer inflation, and everything has become much more difficult. And then on top of that, we've now got major increases in the cost of leverage, seeing a real chilling effect on momentum across all major exit routes. You can see that LP expectations for distribution volumes are really in freefall right now, with 53% of LPs now expecting a reduced flow of distribution capital over the next 12 months. But it's not all bad news. There are clearly pockets of the sector that will be able to buck the trend in fundraising momentum. We asked LPs if there are asset classes within private markets where they expect to increase exposure over the next 12 months. And we saw a major rise in interest in the smaller end of the buyout market, lower mid-market buyouts and mid-market buyouts. We believe that's an indicator that LPs are looking for the ability to generate real value creation without relying on leverage or an overall rise in prevailing valuation multiples. With a smaller buyout, a GP can modernize management structures. They can pursue digital transformation or initiate a roll-up or roll-out strategy, all without too much relying on borrowing, which is becoming much more expensive. Similarly, we were very pleased to see a renewed interest in private credit strategies, which are now moving up LPs' agendas. Income-oriented strategies like direct lending are by their nature floating rate, and they protect against both downside and inflation, while distressed and turnaround strategies may offer some exceptional opportunities in the dislocated markets we're seeing at the moment. Meanwhile, for the first time, more LPs told us they were planning to increase exposure to healthcare than to technology. We expect it to be a real bumper year for healthcare-focused funds, who are experiencing a perfect storm of renewed interest in the sector after the pandemic, some exciting medical breakthroughs, and perceived insulation from many of the macro issues we're seeing at the moment. And sustainability is also edging up LP agendas right now. We believe that that's being driven by two big changes. Firstly, the increased focus across the board on climate and sustainability, creating a real imperative for LPs to engage in this area. But possibly more importantly, it's the emergence of some players delivering truly outstanding performance in this area that is giving LPs the confidence that sustainability and impact funds can deliver exceptional returns for their stakeholders. Looking at LP expectations for deployment by geography, we're seeing North America as the big winner from the geopolitically volatile times we're living through, with an inbound investment Rli score of 60. LP enthusiasm for Asia Pacific has dropped somewhat, with a 10-point fall in the Rli since our last edition in the second half of 2021. Meanwhile, funds in the rest of the world may struggle to attract capital at all, with a very low Rli score of just 30. So in summary, we're expecting a much tougher fundraising environment over the next 12 months, driven by macroeconomic concerns and, in particular, a potential sharp drop in distribution capital returning to LPs. It will be much harder to secure new money tickets, raising the bar on quality for managers to attain fundraising success. But in certain pockets, we expect momentum to be maintained or even to accelerate, offering some very exciting opportunities to market participants right across the private equity asset class. Thanks for tuning in today.